Let's take a look at the first of our steps that we learned about in Chapter 1, which is the analyzing step. And to be able to use the analyzing step, we use a chart of accounts. Each company has its own chart of accounts. And we use the accounting equation. And so this is what we're going to talk about. First, we need to talk about the business entity concept and how it affects accounts. If you look at any particular owners and businesses, the owners may have personal assets, personal liabilities, and the business has its own assets and liabilities. Even if, as we learned in Chapter 1, the owner is a sole proprietor, and legally, in that case, the owner is the business and the business is the owner. But accounting-wise, we always have to keep them separate. We always have to look from the eyes of the business. We have to keep the personal stuff separate, and we're only putting the business stuff into our bookkeeping. And the chart of accounts that we're going to talk about is only the business accounts that are listed in there. Now we're going to use accounts as we keep track of business transaction. So what is an account? It's a separate record for each asset, each liability, each owner's equity or subtype of owner's equity has this separate record. And any increases or decreases in that particular thing is going to be recorded into that account. So if we have an account for cash, which is the money that's in our the business checking account, if we have an increase in that, then we're going to show an increase in the cash account. If we have an account where we owe out to a supplier, we call that accounts payable, and we have an increase in the amount that we owe out to a supplier, we'll have an increase in accounts payable. If we have a decrease in a particular account, then we'll show the decrease in that particular account. A separate record for each thing that the business owns or owes out or has equity in. Now, when we take a look at a business transaction, so we've already separated out anything to do with the personal aspect of it, and we're only looking at the business aspect. Once we look at that, what is a business transaction? It's an economic event that has a direct impact on the business itself. And typically the business is going to give up something, and they're going to receive something that's equal to what they gave up. All the transactions affect the accounting equation. We have an accounting equation, and we'll look at that in a little bit. And that it affects that accounting equation through specific accounts that we have listed. To analyze that business transaction, there's 3 questions that we ask about things. First of all, what happened? What did we receive and what did we give up that's equal? Secondly, what accounts from the chart of accounts are we going to use? And thirdly, how is the accounting equation affected? Does it balance once we get done? If I show an increase in one part of the accounting equation, I need to show an increase in the other part of the equation. So the second question requires us to choose an account from a chart of accounts. So each company has its own chart of accounts, depending on how big that company is, what kind of business transactions they have, dictates what kind of accounts they have. Now, some accounts are very common across the board, such as the cash account, which represents the business's checking account. Okay, that cash account, generally you're going to see that in every organization's chart of account. Other accounts may only show up in a particular type of company, but not in other companies. So each company has its own chart of accounts. But every chart of accounts, and it doesn't have to just be a business, it can be a governmental entity like OC Tech, it can be a not-for-profit like Meals on Wheels. They all have a chart of accounts. And the chart of accounts are made the same way across the board. And the accounts are separated into 5 separate types. So the 5 types are listed always in the same order on the chart of accounts. First are always listed the assets, then the liabilities, then the owner's equity, then the revenues, then the expenses. Here is an example of a chart of account. On the left, you'll see the assets and some examples of some asset-related accounts that would be listed as assets. And over on the right, you see the liabilities with a couple of examples, owner's equity with a couple of examples, revenues with just one example, and expenses with a couple of example accounts that would be listed under that type. So there's the 4 types. They're always listed in that order. Sometimes, and we'll talk later when we get into journalizing and posting, they'll have account numbers for each account. So since assets are listed first, all the asset accounts would have an account number that starts with a 1, liabilities with a 2, owner's equity with a 3, revenues with a 4, and expenses with a 5. Assets are the first types of accounts that are listed in the chart of accounts. What are these? These are items that are owned by the business that will provide future benefits. So if the business owns, say, a piece of equipment, if it owns the checking account, those would both be assets. Okay, the asset doesn't have to be paid off. So if the business purchases a piece of equipment, but it owes out to the vendor for that, then it still owns that piece of equipment. Of course, the vendor, if we stop making payments, the vendor can come and take that piece of equipment away, can come and repo that piece of equipment. But we basically own that piece of equipment, so the equipment itself goes as an asset in the chart of accounts. Here is examples of some common types of accounts that would be in the asset section. Okay, cash again is the checking account. But any other kinds of accounts, if we had savings accounts or investment accounts, those would also be assets. Accounts receivable, we'll talk about that in a minute. Inventory, these are the products. If we sell products, these are the products that we have either made or already purchased that we're going to resell to the customers. Furniture and fixtures, equipment, buildings, supplies that we use ourselves. We're not reselling these supplies. Prepaid expenses such as insurance policies that we have paid in advance or rent that we have paid in advance. These are called prepaid expenses. Okay, and so all of these things are things that we own, okay, but and they're going to provide us with future benefit. And so they are assets. Now let's quickly run through. We already mentioned cash. We'll talk about accounts receivable in a minute. And we talked about inventory. Furniture and fixtures are things that are in the store, typically, or the office, if we have an office building. And these are desks and things like that. And fixtures are things like lights and display cases, things that are attached to the walls or attached to the flooring. They're now part of the business, a building, as opposed to furniture, which if we move out of, if we're just renting this building and then we move out to a different building, the furniture we can move with us. Things that are attached to the building, like the light fixtures, we're not really technically allowed to take those. Those are called fixtures. Okay, but we still own them for as long as we're in that building. We own those things. Okay, if we're the ones that purchased those things and then attach them. Equipment, any kind of factory machinery or any kind of office equipment, computer equipment. This can also include vehicles if the business owns any delivery vans or other vehicles. Buildings, any kind of buildings that the business owns. Now, we might rent a building space, but if we own the building, they would be an asset. If we rent a building, then that's not an asset. It would not go on our chart of accounts. Supplies are things that we use. They might be shop supplies, cleaning supplies, office supplies such as paper and pens. So they can be any kind of supplies that we're purchasing and we own them, but we're going to use them ourselves. We're not selling them to somebody else, like the inventory. Prepaid expenses, as I said, would include something like prepaid insurance. If we go purchase an insurance policy today, we now own that insurance policy. Now, once any time has gone by, that insurance has covered us. So if you buy a car insurance policy and a month later you say, okay, I'm going to get rid of this car. I don't need this insurance policy. I want my money back. They're not going to give you all your money back, only part of your money. The part that is the part that you haven't used yet, the part that you still own. So in prepaid insurance is going to be the account on the asset section of the chart of accounts that's showing how much of the insurance policy we still own. And we'll talk about adjusting entries later in the semester. Okay, we said we would talk about accounts receivable separately. This is an asset. This is where customers owe us money. And so, yes, we own the money even though it's not in our hand. If the customer owes us money, it happens that money is in their pocket, it's in their account, but legally it's our money. We own that money. And we're going to receive it in the future.